So, dear students, up to now we have seen about the four units of energy auditing and demand side management. So, on those first three units are comes to the category of the energy auditing, and the remaining two units are for the demand side management. So, in the previous discussions, we see about the unit 4 also. So, now in this video onwards, we will see about the unit 5 concepts. So, what are the various topics present in the unit 5 are basic payback calculations and NPV. NPV means net present value, taxes and tax credits, and some numerical problems regarding this one, and importance of the evaluation, measurement, and verification of the demand side management programs, and the cost effectiveness tests for the demand side management programs, and various cost effectiveness tests are there: ratepayer impact measure test, and total resource cost test, and participant cost test, and program administrator cost test. So these are the contents in the fifth unit. Fifth unit. So what are the objectives in the fifth unit are to understand the time value of the money concept, and to study the different cash flow models, and to develop the a cash flow model for uniform series, compound amount factor, and a single compound amount factor, and to learn about the payback analysis, and to understand about the depreciation, and to explain the meanings of life cycle cost analysis, and to learn about the tax and tax credits. So some common terminology in energy economics are: first one is the fixed capital. That means initial amount to put to run a industry or to run a project. Initially we will put some money on that project, so that money is comes under the category of fixed capital. So which capitals or which costs comes to the fixed capital cost means cost spent for the purchase of land, plant, and equipment, and capital cost of the generating equipment, and capital cost of the transmission equipment, and capital cost of the distribution equipment. So these all are put at one time, and these can be used for the these are to be fixed for up to the last extent of our industry or plant or equipment, whatever it is. So these are the fixed cost. And running capital cost. So running capital cost means capital for purchase of the raw material. So while functioning the industry, some raw materials will be required. So for purchasing the raw material, that material cost will become to the category of the running capital. And in the running of the industry, some workers are present in the industry. So we have to give the salaries and wages to the those personnel. So payment of salaries and wages, and some fuel cost, and maintaining and repairing cost, and the cost of the water, and the cost of the lubricating oil. All these concerns are comes to the category of the running capital. And the in common terminology in energy economics, another word is taxes. So property taxes levied on the generating station buildings and substation buildings, etc. Not only for the buildings, for the employees also some taxes will be there. So that can be, that means direct tax, that is. So tax should be paid to the municipal corporation for the use of the street roads, and income tax from the employees, income tax of the employees. All are the various taxes in energy economics. And insurance charges to cover the risk of fire to the buildings, and to cover the accidental breakdown of the buildings, and workers compensation. All these are the insurance charges, and this is also one of the point in the energy economics. And depreciation and sinking fund. So after a certain time, the equipment is to be replaced because of its physical and functional reasons. So plants has worn out and become unfit for further use. That is the physical reason. And capacity of the plant become inadequate due to the load growth at the present years. So that is called the functional reasoning. So with these two reasons, the cost of that particular plant will be reduces. So that reduction is called as the depreciation. So however, we will describe detailedly in our further classes. And interest. So interest is the earning power of the money. So it represents the growth of the capital per unit period. So the interest rate can be depends upon the period. The period may be a month or a quarter or a semi-annual or a year. Interest is the income produced by the money that is lent or loaned. Simple interest and compound interest are the type of interest rates. And based upon the interest rate only, the earning power of the money will be depends. As the interest rate increases, the earning power of the money will be increases. And as the interest rate decreases, the earning power of the money will also be decreases. And cash flow models. So what is cash flow? In financial accounting, a cash flow statement, are also known as the statement of the cash flow, is a financial statement that shows how changes in balance sheet accounts and income affects cash and cash equivalents, and breaks the analysis down to operating, investing and financial activities. So the flow of the cash in that particular plant can be formed as a statement or from a diagram, that is known as the cash flow model. So a convenient way, this is a convenient way to display the revenues and costs associated with an investment. So for our investment, what are the revenues we have obtained and what are the costs we associated, those all are simply identified by the cash flow model. So different types of cash flow models are available: end of period convention and mid period convention and continuous period convention. So at the end of period convention, all cash flow which occurs at any time interval assumed to occur at the end of each interval. Simplify the computation and errors. So here the above diagram illustrates the 3 years of duration. Only the flow will be considered at the end of the year only. And the mid period convention, cash flow can be assumed to occur at the mid period also. So for every year, at the middle of the year also we can consider the cash flow. So figure illustrates the 3 year duration of the mid period convention. So for the first year, this one is the mid period convention, and for the second year, this will be the second mid period convention, and for the third year, this is the mid period convention. So finally we have six cash flows for a mid period convention for 3 years. And continuous flow convention, cash flow for any period are received at any continuous rate. The following diagram shows this 8 cash flows per year, again over the 3 year period. So for every year we consider the 8 cash flows. So let us see: 1, 2, 3, 4, 5, 6, 7, 8. So here also 8, here also 8. So these are the 8 cash flows per year up to 3 years. And time value of the money, if the money value will be changes based on the time, then the concept is called as the time value of the money, or present net value, NPV, net present value. So the change in the amount of the money over a given time period is called time value of the money, I am already told. And money can make money if invested, and money made depends upon the interest rate. As the interest rate increases, the money will be increases. As the interest rate decreases, the money will be decreases. And money has a time value, definitely. That's why we discuss this topic, time value of money or net present value of the money. So money can be spent, money can be borrowed, and money can be kept. As the money to be considered as depreciation. So if the money will be spended or money to be borrowed, then we consider that is as depreciation. And to compare the various options or alternatives, it is necessary to convert all cash flows for each measures or scheme into equivalent base. This is based on the guiding principle that money in hand today is more valuable than money received at some time in future. To convert cash from one time to another, different techniques are to be used. So various different techniques for the time value of the money are single payment compound amount, and single payment present worth, and uniform series compound amount, and sinking fund payment, and uniform series present worth, and capital recovery, and gradient present worth. So these are the different techniques of the time value of the money. So for our syllabus point of view, just we know about the titles only. There is no need to detailed discussion about the this time value of money techniques. The remaining topics we will see in our next video. Thank you.